Hi, I'm Lorraine McGregor, and I'm going to explain to you how to get a return on your investment in your company by showing you the 5 steps that get you the financial future you want. Now, I'm not a mergers and acquisitions advisor or a business broker. My husband, Rob McGregor, and I are management consultants. We have written the books, How to Increase the Value of Your Business Before You Sell and Make It More Profitable Now, as well as our textbooks for our clients, Fast Track Secrets for Making Your Business Saleable, and its companion playbook that builds you the saleability blueprint that doubles or triples the value of your business. Now, we've been doing this kind of work since 1990, and our clients all expect to grow to the next level so that they can turn their business into a saleable asset. And today I'm going to reveal for you how we do that for more than 100 clients in a huge variety of businesses. So what we're going to talk about is reframing the exit question so that an ROI is possible. And I'm reading that bullet exactly as stated because that is the problem. How people and business owners and advisors think about exits is confusing the issue about what is possible and makes the exit decision really difficult. I'll show you your personal financial and business financial options. I'm going to present a fascinating case study to show you how they got their return on their investment and show you how to get started in making the kind of decision that will impact your financial future in a way that really gives you a sense of control and something really important to look forward to. So you have financial certainty for your personal family and your business family. So think about it. What got you started in your business? What was your desired end result? Many entrepreneurs got started because they didn't want to be employees anymore. So that's looking to the past, and they wanted to grow something or prove something or solve a problem for somebody, but they didn't always think about their desired end result. So that is step one. You maybe are at an age now where it's time for you to think about how your legacy is going to unfold and what's important to you and all the stakeholders in your business. So many of our clients actually want to make sure their company continues long after they leave so that their people, the people that help build the business, are continuously rewarded and their families can rely on that career continuing. So let's think about it. There are actually 2 kinds of successful companies, and the reason I say that is I'm looking through the lens of a buyer, and this is the first step in understanding how buyers see your business. Both give the owner a very good lifestyle, and both provide invaluable economic benefits. You provide a job for your employees, you provide key components for your suppliers, you provide a reliable place people fall in love with for your customers. But 90% of businesses today across North America, the United Kingdom, Australia, New Zealand are run in a way that makes selling the company very challenging. And I'm about to dive into why that is. Only 10% are run in a way that will earn the owner a substantial payout, which gets you your return on your investment. So why would you want to sell what you've built? I know there's a lot of confusion about whether you should sell or bequeath your company to your siblings, your relatives, to keep it in the family. And that idea is a big reason to want to have a legacy. So, reason to sell, the money that you built up inside your company belongs to the business. So if you want to return on your personal investment, you have to sell your stake in it. A lot of owners are, had a great run leading the business and they want to try something new. As we've spoken about, the legacy isn't so much that you've built a business. Your actual brilliant legacy is that if you continue to allow your business to grow and thrive long after you leave, that is a fabulous legacy. So that requires that you pass the torch on to those that can lead growth. And oftentimes, to turn a business into a saleable asset, you can't be the person at the helm anymore. Making sure that your business can give you a return on your investment will create family financial security going forward. Most of us are living a long life today, and you stop working, where's the money going to come from to support you? And you have to create certainty for all your stakeholders, especially if your company has distributors or you have a supply chain. Those companies rely on your business to continue to be an important puzzle piece for their business. And if you believe in capturing appreciation of all your assets, not just your stock portfolio, it might be something really important that you learn how to sell your business. So what is important to you? And maybe these are questions you've never considered before. And in fact, from our perspective, we know that advisors are not asking these kinds of questions because no one understands what it takes to sell a business. This is new. We're in new territory here. So I want you to know the facts. You're looking at a graph. This is 3.5 million business owners, and I'm talking North America here only, so that includes Canada and the US. In 2005, the Canadian Federation of Independent Business and the Small Business Administration in the US did a survey of business owners, and they counted the number of boomer business owners in North America and found that there's 3.6 million. In 2007, PwC also did a survey and found 3.6 million business owners, and they asked those owners in both surveys, when do you want to sell? Well, 2.5 million owners said they want to sell in the next 5 years. Well, that would mean that 2.5 million businesses would sell between 2005 and 2010, or 2007 and 2012. Now, in 2000, I actually joined the Association for Corporate Growth, one of the loan management consultants in the group of deal makers, mergers and acquisitions advisors that transact the buying and selling of businesses. And I joined that group because I wanted to understand on our clients' behalf what makes a buyer want to acquire a business. And the reason you need to know this is because I discovered that buyers are incredibly picky. They look at hundreds of deals and pick 2 or 3 to acquire every year. So because I knew this, when I went to Intergrowth in 2012, that's the Association for Corporate Growth's annual conference, I asked Capital IQ, those are the people that track the number of deals in North America, to find out how many business owners actually complied with their intention and said, yep, if I'm going to sell in 5 years, I'm going to make it happen. Here's what they told me. They ran the numbers, and 199,474 businesses actually got an exit in that time period. And I was shocked. I mean, here I'm thinking, representing my clients, and I'm looking at less than a 10% chance that they're actually going to be able to sell. And I thought, my goodness, everybody says, oh, well, the economy hit 2008, 2009, 2010. Business owners didn't put their companies on the market, and that's what happened. Well, I actually dug around a whole lot more, and talking to business brokers, M&A advisors, and investment bankers across the country, and this is what I discovered. 1.7 million business owners attempted to sell their companies and failed. Now, astonishingly, I have to ask, why did this happen? And as we dug around, we discovered that here are the reasons that business owners are failing to sell their companies. They get a false sense of security. So yes, this is partly the M&A advisory group's fault. They hire MBAs to do telemarketing. They call businesses up. They say, come to our seminar. We'll tell you all about how we're going to package your business up. And we have buyers looking, so you should be able to sell your business. And owners are getting those calls 2 or 3 times a week, plus letters and cards inviting them to come to these seminars. So there's this sense that, well, I can sell my business whenever I want, and a high degree of irritation that they get these calls all the time because they're going to sell when they want to. Also, many business owners think about owning a business in the same way they did about their having a job. A job, you retire at 65, so they coincide wanting to exit their business at 65, but that isn't necessarily the best time or the ideal time to try and sell a business. And many owners get caught rather than being intentional about when they want to sell, but caught in circumstances. Life sends them a curveball, and suddenly the judge says you have to sell the business to satisfy a lawsuit, or you have to sell because of health issues, and you are never in charge or control of the value, or even if you can sell, when you don't have a planned exit. There's a lot of confusion about the term succession. Succession, in the way it's talked about by your accountant and your lawyer, is putting your estate and your will in place, minimizing your tax situation, setting up trust companies for who's going to hold your assets. None of this describes what it takes to actually turn your business into something that another buyer actually wants and will pay you the amount of money that you want to sell it for. And then we look at why buyers actually acquire companies. Many owners don't understand what buyers look for, and they look for risk-free opportunity, meaning that they can actually see how your business is going to make them money and get them into a new market in the next few years, and do it in a risk-free way. And if they see risks, they're not interested in acquiring the business. We'll go into that more deeply shortly. So all in all, business owners don't find out that the company must be made saleable until the year they're trying to sell the company, and they're not finding an M&A advisor or even a business broker who's willing to represent them, because those agents only take on clients that have made their business saleable, because they don't want to represent an asset that a buyer wouldn't want to acquire. And there are many reasons why a company isn't saleable, but one of the big ones is that the current owner is unwilling to change out who leads the business in the year or two prior to the company being sold or being put on the market. And that unwillingness actually creates a big risk for buyers, because if you own the relationships, you own technical knowledge or how the company sells its products in your head, then, and you are not intending to stay with the business, that knowledge has no value to the business or the next buyer. That creates a huge risk. So, and for a lot of owners, it's just easier to work on what's immediately in front of them rather than sitting out, setting plans, and working on the intention of how you want to wrap up your business, like your return on investment. So these all contribute to why the failure rate is so high. And the news gets a little tougher. So I wanted to really understand why that failure rate was high, and to validate that it is still happening today, even for successful business owners who would think anybody would want to own my business. And what we discovered, because of a survey an investment banker did, and it was a private survey, and I got access to it because of my involvement in the Association for Corporate Growth, is that 90% of business owners never find buyers after 3 years of looking, and the 10% that do are actually making a commitment 2 to 4 years before they want to sell to make the company saleable so it is ready at the time their ideal buyer is looking and worth what they want to sell it for. And that is inside information that even your accountant and lawyer, financial advisor don't know, because they don't spend time with the deal makers. That's what we do. And even more importantly, so we're looking, is it a demand and supply issue? Well, we know that 3.5 million boomer business owners are going to have to make a decision about which way they're going, whether they're going to sell or not. And there is $10 trillion looking for saleable businesses. So it's not that there isn't a demand for those businesses. It's that the supply of saleable companies is very low. So think about that for a minute. If you want to get into the 10% that do sell, you have to make the commitment long before you ever want to sell to turn your business into a saleable asset. And when you do, buyers will be falling all over you to pay you a premium. So what do we mean by saleable? And what do we mean by worth what you want to sell it for? Well, here's an insight into how buyers think. Every one of the issues I'm about to go through does two things for you. It removes the risk from your business that cause you profitability problems and predictable revenue problems. And those are the very things that buyers look for. They want a risk-free opportunity to continue to grow the business. So step 3 is all about coming to terms with the elements that need to change inside your business so it can be transferred to another owner in such a way that growth continues and the new owner can replicate your success without a downturn. Now, every one of these changes brings a big benefit to you and the future investor. And of course, you are the current investor. So why not do something that makes the business more profitable so that cash flows, retained earnings grow, and you can afford profitable growth? So here we go. We need systems, predictable revenue, and predictable profit. Well, to get that, you've got to be able to do forecasts accurately and show how you're going to get the profit, and then produce a plan that actually gives you the profit. And that knowledge of how to get predictable revenue and profit is in the procedures, the training, the IT systems of your company so that everybody knows how to do that, not just the boss. It's so important that no one customer makes up more than 20% of the revenue of your business, because if they do, then the risk of you not making your revenue that year is really high. Also, this may seem counterintuitive, but a narrower market niche leadership actually results in higher growth. The narrower the niche, the more problems you solve for that niche, the more they love you, the more they sign up for more. And so buyers look for strong standouts in markets that are not easily accessible by their own strategies. And that you have a growth plan underway. It's not that you're selling the company because you're too tired and the revenue shows it. You have a mission and you're growing, and the work that you're doing actually proves the growth. Which leads us to people. Your people will be known for growing the company rather than you. Yes, you've grown the business up to now, but with the professional leader who writes down the plans about how they're going to get predictable revenue and profit and then sets goals and metrics that achieve it, you can demonstrate that you have a team that the buyer can bet on. So they know how to make and how the company makes and loses money, which means you've got star performers on board. And because you're growing the company and you're going somewhere with it, you attract more star performers, and those people increase the value of your business. Because you're set for growth, your organizational structure has to be scaled for growth. So it's easy to see where you'll be investing in new roles, and people can see how they're going to move up in the company as well. So they have careers that are going places. Your organizational structure helps them see how they're going to get their value by being one of your employees. And your management team and your professional leader or general manager develops the vision, creates the plans, sets the goals and metrics, of course with your help, because by this time you'll be sitting on the board reaping the benefit of all that your people and systems have created for you. That is step 3 in coming to terms with making your business saleable, and these very items make your business more profitable. It's a really exciting journey. Our clients love doing it. So here's another key ingredient, and it's all about you and your mindset. If your intention is to turn your business into a saleable asset so that you can get your return on your investment and stand out amongst other prospects a buyer could acquire, then these changes will have moved you on emotionally. You've been able to let go of your business because you've acknowledged your own efforts and everything you've done to build up this business so that it can be a legacy that you can leave behind you. You're ready for your next act. You look forward to your life without your business. It's not that you're hoping that the buyer gives you the amount you hope it's worth. You've made the changes to make the company work in a way that makes it worth that to a buyer. By the way, I want to make a big point here. These changes for what makes a company saleable is necessary regardless of who you want to sell to. If you want to sell to family or a key manager or all your employees or to a strategic buyer or private equity, you need to make these changes in the business so a lender would be willing to fund your business, because of course the future revenue and profits are what's going to pay for your employees or your family member to acquire the company from you. So how do buyers calculate business value? And I know this is a very tender subject. There's a lot of confusion about business value. There's all that you value, and you maybe put a price on that, and there's what a buyer values. And these two values are very subjective. And you have to let go of the way you value your business if you want to be able to sell it for the price you want to sell it for. So let's understand how a buyer looks at value. So just like you do, like a real estate agent does when they evaluate a home, they look at comparable homes in comparable neighborhoods and come up with a price. Well, buyers do the same thing through their M&A advisors. They look at companies that have sold for multiples of EBITDA, earnings before interest, tax, depreciation, and amortization, and then assess a value based on that back of the napkin valuation. Now that is a very rudimentary way of assessing value, and it's not, this method is not to be used to prove the value to anybody else but yourself. It's a way to set a baseline so you understand the difference between what you want to sell it for and what it could be worth today, and so you can close that valuation gap. And the goal is to add economic value to the multiple and the EBITDA so that your valuation comes in higher. Now, it takes about 2 to 5 years to make the changes that add value to the multiple and add to the EBITDA. And not every business is going to be able to do that. And not every business has the same multiple. Different industries have different multiples. So just because a friend of yours might have been able to sell at a certain multiple, like 3 times or 7 times, or if you're in information technology, 15 times, it doesn't mean that you'll be able to sell at that multiple. So it's really important to get a clear-eyed understanding of what your value of your company is today using this back of the napkin method. And all of that brings us to a fork in the road. You have a choice. Your business has given you a great lifestyle. So on the right side, you might decide that maintaining that lifestyle is important to you, and that's all you want to do. You don't want to turn it into a saleable asset. On the left side, you might decide that making this a wealth-generating asset so that you can sell it for a premium and fund your nest egg is what you really want to do. But making this decision involves a lot of difficult decisions. And it's really important to be able to make an informed decision so that you know what you're going to do. So step 4 is understanding what goes into this decision. And let's look at the first of many catch-22s that business owners struggle with. So is it the chicken or the egg? Your nest egg, where will it come from? Well, it might come from your savings, from your dividends and salary, or it might come from turning your business into a saleable asset. But part of making this decision includes accepting that there are multiple catch-22s in owning a company. You know, the difficult thing to recognize is the value that you personally built up in the company belongs to the company, not to you. And the only way to extract that value is to sell it. Your business is valuable as long as it continues to grow, which takes more cash and it takes more investment. You get life satisfaction from running your company. Personally, it may be hugely rewarding and give you a sense of achievement, and your role gives you material success. For many owners, the company they created is evidence of their obvious success. So it's pretty hard to envision giving up that public identity and proof you are very successful. Yet your family is relying on you for their financial security. Your employees are relying on you for their continued careers in a company that's going somewhere and growing and is a vibrant place to work. You may also be subject to an industry that's constantly changing or not changing fast enough. If you think about your own financial security, what you can rely on is that you've saved up to now, what you've saved up to now. What and how much do you want in your nest egg to take care of your personal and business families? And ultimately, your job is to take care of all needs by making an informed decision so you take care of what is most important. No decision puts all these competing interests at risk. You can't think through these catch-22s by wearing your personal hat. You have to make the decision that is best for the business, and that means wearing your CEO hat. Because when you take care of what's best for the business, you take care of all stakeholders, personal and business. Because the business becomes worth what you want to sell it for to fund everybody's future. And when you wear your personal hat to determine the financial future you want, it gets very confusing because you're trading off one set of needs for another. Once you've analyzed both sides and come to the same conclusion that we have with our clients, that the business needs take care of all needs, then you can come to the best decision for all sides of your business and your personal family. So let's dig into the numbers. You and your business are at a fork in the road moment. And as I mentioned, we have a business banker and wealth manager help us crunch the numbers, Jamie Ferguson, on whether you should consider the wealth generating choice or the lifestyle choice is going to be just fine for you. So let's break this down. So Fidelity International actually did an analysis back in 1972 to evaluate how long $500,000 would last a retired person. Now, based on a withdrawal rate of 10%, 8%, 6%, they looked at how long that money would last so that they could advise their clients how much they could take out of their life savings given their age. So what they discovered is that 4% per year, this turquoise line here, actually allows all the money they've saved up during their working career so that they could make that $900,000 last until they passed on. Now, why this is important is because $1 million saved today is going to provide you $40,000 a year in income. Now, that's a function of the Fidelity graph, but it's also a function of the return rates that we're seeing with investments. So your choice about the lifestyle or wealth generating option is going to depend on what your current financial plan reveals. So what assets are going to provide you with your nest egg and with cash flow after you close the business? Because remember, 90% of owners cannot sell and 10% can. So if you just hope that you'll be able to sell without making a clear intention today, then you've got to rely on your pension, your RRSP, TFSA, or if you're in the US, your IRA, and your taxable investments, any real estate you have, and any inheritance that came to you. So you look at those portion of your investments and go, is this going to take care of me, my family, until we move on? But what if something happens to you? What if there's a health change, an accident, your industry takes a downturn, or you served with a lawsuit, or you can't sell your company? All of your financial planning may fall apart. And so you have to consider that when evaluating whether you want a wealth generating asset or it's okay to have a lifestyle company that you close one day. I want to take you through a case study so this becomes more real for you. So these are our clients, Mary and Eric. They each have a holding company and they own a business together. Mary owns 60%, Eric owns 40% of ABC Contracting. It's an HVAC company. And in the year that we met them, they had revenues of 20%, an EBITDA margin of 7%. Remember, that's earnings before interest, taxes, depreciation, and amortization, or for your benefit, the bottom line, which meant they had $1.4 million. So Eric came to us and said, I don't know, should we make the business saleable? I'm only 57. What should I do? And of course, our position is you have to look at your personal financial position at the same time that you look at the saleability aspect of your business. So Eric has $520,000 in savings. And what we've known from statistics is the average self-employed entrepreneur has about that much in savings once they hit their mid-50s. He doesn't have any debt, so he's paid off his mortgage, and he takes home $282,000 a year in salary and dividends. He contributes as much as he can to his RSP, his IRA, his TFSA, and excuse me, he spends about $14,000 a month on his life. He gets an investment return of 6%. We're considering inflation for 2.5%, and he pays Canadian and British Columbia tax. He wants to exit by the time he's 65 because he didn't know that that was something he shouldn't consider, but today's life expectancy is 90. At this point, we also need to note that Eric is kind of rare. Most people do not maximize their RSPs, their IRAs, and there is actually $500 trillion of unused RRSP contribution room. So we know that many business owners don't have not contributed to the maximum, and therefore may not be in that same financial position Eric is. So we also learned from Fidelity Investments that we should all plan to live a long life. They are tracking the fact that 50% of people living to age 65 will actually have a 50% chance to live to 85 years and a 25% chance to live to 92 years. And if you're a female business owner, you're going to live even longer. If you were a couple, even longer. So you actually need more money than you think to be able to continue the lifestyle that you have today, and so that you take care of your health issues as well as your financial expectations and what you want to do in your retiring years. So when Eric is faced with all of this, we presented 4 potential outcomes. What do you think he should do? Here's his first option. Like 90% of owners right now, he could just hope to sell at 65 and not bother to make the company saleable. And here's what would happen. Right now, Eric drives a new BMW he gets every 2 years. He and his wife enjoy the luxury of $14,000 a month income today. But if he can't sell at 65, even though he planned to, when he closes the company, he has to expect a 51% lifestyle reduction at age 65. That would mean he's driving a Toyota Echo. Now, I know Eric, and I don't think he's going to be too happy driving a Toyota Echo. And worse, there is no legacy for his kids. He will have spent all that he had saved by the age of 90, so there will be less than $100,000 for his children. Okay, so what's Eric's next option? Well, if he can't sell the company, then he's going to continue working like a lot of owners tell us they're going to do. He'll work to 75, but he won't make the business saleable. He'll just close it down. So he'll go from that BMW he drives today to keeping that same BMW, which of course will be 10 years older by then, and he'll take a 17% lifestyle reduction. So he won't be able to live in the same way that he does today, but it's not as painful as if he closed the business at 65. Eric is not feeling too happy about that, and his wife is even less happy that he works to 75 and that the fact there's still no money for children to leave to the kids. So here's number 3. Our favorite option: no, reduce spending. Forget the BMW every 2 years, switch to a Honda Accord, and for the foreseeable future, if you reduce spending now by 32% and keep maxing out those RRSP, IRA, and TFSA contributions. And he'll close at 65. But at least between now and then, he will have saved a whole lot more, and if he lives a modest life, he should be able to get to 90 and take care of all his financial expectations. However, there is still no money to leave to the children. Now his wife is getting a bit anxious. What about option 4? What if Eric and Mary together decided to make the business saleable? Well, that's a commitment they have to make 2 to 4 years before they want to exit. So there he is. He's still driving his BMW, and once he sells the business, he's going to be driving a Porsche. Because he and Mary are able to sell the business for $8 million, he can continue getting that $14,000 a month income until he's 90 and leave a $3 million legacy for the kids. So how did Eric actually do this? Well, before we step into that, I need to tell you something. Now you know the facts of the 4 options. Think about which choice makes the most sense for you, because there's many more options if you select making the business saleable, including holding on to the company and hiring a general manager so you don't have to work all the time. But it all depends on the legacy you want to leave for your employees and stakeholders and your personal financial position. But like most of us, our comfort zones are how we live our lives today, how we spend our money today, how we are in charge and in control of our companies today. And so I want to warn you that making your business saleable, option 4, is actually outside your comfort zone. And if you choose not to be intentional, and if you postpone this decision, you're going to get option number 1, ending at hoping to sell but having to close because you couldn't find a buyer, or number 2, having to work until age 75 by default. And it is much more difficult to deal with change that other circumstances impose on you, like expecting to sell and not being able to, than by intention that you bring about in your life, choosing to make your business saleable and working towards making that happen. So the change that you bring about yourself is far more inside your comfort zone than change that's imposed on you because what you hoped for didn't happen. So here's how Mary and Eric did it. When we met them, their HVAC company was bringing in revenue of $20 million, EBITDA of 7%, and so they had a multiple of 3 times. And in their industry, HVAC, that's pretty generous. Most HVAC companies, if they can sell between 2 and 3 times. And most of them can't sell because they don't have predictable revenue. So at this back of the napkin valuation, Mary and Eric have a business worth $4.2 million, but it's not saleable. So no one would give them $4.2 million. And when we sat down with them and created a saleability blueprint for them, they set a valuation goal of $8 million, which means we had to figure out how to help them close that $3.8 million valuation gap. Now here's why the company's not saleable. We call these red flags. And on the left-hand side here, we have the enterprise value. On the left and on the bottom, we have the value to the buyer. And the more red flags there are, the less value there is to the buyer, and the lower the value of the business they'd be willing to pay for it. So on first glance, Mary and Eric, when due diligence starts, are not able to control how they price their services. When you bid on projects, you have to compete to stand out to win the bid. And competing on price means you have a very razor-thin profit margin. Now, one of the reasons they have a razor-thin profit margin on all their projects is because of the way they manage their business. They have very inconsistent profitability, meaning if they say they're going to get 10% return on a project, often they bring in far less than that, and they don't know how to uncover why those projects make and lose money. And what we discovered when we started to dig into these red flags is that there wasn't enough of common systems on how they managed their job. So one project manager would be able to bring their project in on profit and the other couldn't. And so they had inconsistent systems, and not enough of their revenue came from service, which did come in at a predictable profit. Also, we discovered that Eric and Mary couldn't track the margin variance on their projects. They didn't understand which projects and products drove growth. Each of these were significant red flags, and of course, the biggest red flag was Eric himself. Eric should not be material to the business, yet he ran operations. When he managed a job, the projects all came in at a profit. When the key people that he worked with worked on the projects, they came in on a project. If he didn't pay attention to one project manager, that project wouldn't come in on a project. That profit wouldn't come in on the project. And Eric and Mary shouldn't have to make all the key strategic and financial decisions, but they did. And their people didn't know how to make those decisions, so every day they had to be in the office 10, 12 hours to make sure the right decisions were being made. And of course, the bigger the company grew, the harder that became. They had to have a management team that would have the skills to grow the company without Eric in operations and Mary leading service. So their own constraints and how they controlled their business by what they did created the red flags, and to a buyer that spells risk. And wherever there's risk, it reduces the value to the buyer. So here's what we suggested they needed to do. After fixing those red flags that we just discussed, we needed to increase the value to a buyer of an HVAC company and increase the enterprise value. So we had to get them to profitable, stable earnings. And what we suggested was that they had to have many more service contracts and switch their revenue from being 20% project-based and 20% service-based and 80% project-based to the reverse of that. They had to have far better reporting and key performance indicators to tell them where they needed to pay attention because profit was slipping away, and where they had to improve how labor was being managed. And they needed to understand who to hire and how to hire capable management. And of course, what we'd hear from Eric is, well, I've tried hiring project managers before, but they would never do what I wanted them to do. And what we learned is that Eric didn't know how to mentor people. He expected, like many senior managers, if they explain it once and you hire a good person, they should be able to get it. But what Eric and Mary were building were unique systems that other competitors didn't have. And so they had to do a lot more mentoring to be able to grow their company. And each time they added one of these green lights, their multiple would grow. And what we discovered in unpacking all their business issues is that they didn't have a clear growth pipeline. So we started to help them become a niche player in HVAC, working on clean tech rooms, clean rooms, healthcare facilities that needed really finely tuned HVAC systems. Then they would get this much bigger increase in the multiple because they were in a narrow market niche. So when Mary and Eric realized that they needed to move out of the way in order for their business to become saleable and get a team that could grow the business for them, they started to examine what each of them did for the business and create new job roles and a new organizational chart. And they started to hire for those roles rather than trying to find people exactly like them to run their business. And you know, that takes a while to do that. But here's what benefit they created. Over the 2 years we worked with them, we learned that their HVAC EBITDA 7% was quite low for the HVAC industry, and in order to be of interest to an HVAC buyer who'd be consolidating their business, they'd want a 9% EBITDA. So by fixing those red flags and adding those green lights, here's what we did. 80% of their revenue started coming from service, 20% from projects. And because of that change in predictable revenue, we created predictable profit and increased it to 10%, because if you want to stand out in the market, you need to be better than the benchmark average. And by adding all those systems into their business and hiring that management team, we increased their multiple from 3 times to 4 times. And look at the impact this has on their value. In just 2 years, they almost doubled the value to $8 million, which was their goal. And now they are a saleable organization because of the changes they made here in EBITDA and the multiple. So the profound moment for Eric was when he realized that he was about to become a millionaire at age 57. Because what happens is when you make your company saleable, those businesses that want to acquire companies like HVAC in this case are already watching you. Eric and Mary got a call. They entertained a buyer who was willing to give them $8 million for the company. And the day after Eric and Mary signed the deal. Eric became a millionaire at 57. So he retired earlier than he'd anticipated, and he loved it. He wanted to stay retired. Mary, she still liked business. So she actually joined the new owner's board and is helping grow service to the next level. And she's happier than she's ever been, and she's a millionaire too. So here's the wealth building transition strategy. You might think, I don't want to be selling my company at age 57 and I want to work less. So here's the way to do it. If you commit to making your business saleable, you can develop your saleability blueprint like any business owner is going to have to do if they want to create a wealth generating asset. We identify the red flags, we identify what green lights needed to be added, and then you start mentoring your management team so that they can take on more and more responsibility. You transition to the board and you replace your functional role. Eric had to find an operations chief, Mary had to find a service star, and then you develop a role for the GM. And of course, your business has to be able to afford that GM, but by fixing those red flags, we find the profit leaks that make this role possible. And then you go through the process of finding, hiring, and mentoring a general manager, and then you can step back. You're still in control of the business, but the general manager their performance is based on adding those green lights that are going to attract a buyer. And you continue to earn your return, the business is more profitable, and you're working a lot less. Yes, this is a 2 to 4 year process, but boy, is it effective in giving you a return on your investment. So, here are the 5 steps that we've discussed for getting a return on your investment. Choose your desired end result now. Where do you want your business to go? How do you want to wrap up your legacy? Then evaluate what motivates you to want to sell. What's important to you personally? Then, wearing your CEO hat, evaluate the saleability of your company. Sitting down with a financial planner that understands business, evaluate your future financial needs. And then get the right advice so you can make an informed decision. Do you want the lifestyle business that will probably close one day, or the wealth generating option where you turn your business into a saleable asset? And then take appropriate action, because nothing stalls your best intentions than not taking action. So you might want to take time to talk with your wealth advisor or evaluate whether your business could become saleable. We're happy to do that with you. You can give us a call and my assistant can make an appointment with you. And I strongly suggest, in order to understand whether this decision's right for you, you get how to increase the value of your business before you sell and make it more profitable now. That is step 5. You gotta learn to play the game. I've really enjoyed speaking with you, and I wish you a saleable company if that's the right next step for you. Thank you.